Hello, you're watching The Plain Bagel. For those of you who have seen the movie The Big Short, which is a great finance movie on the 2008 financial crisis, you know that there are these scenes in there, these celebrity cameos, where they kind of explain in layman terms these complicated financial products. And today I thought it would be a funny, topic for a video to go over these explanations and explain them. My thinking is that these scenes obviously gloss over a lot of detail, and so by kind of diving deeper into what they're talking about, I can tie it back into the actual financial products so that you actually have a more detailed understanding of, what they're talking about, and, maybe you can impress someone at a Thanksgiving dinner or something. And at the end of the day, I just thought this was going to be a funny idea, so I'm going to do it anyway. Whatever. So first up, we have the scene with Margot Robbie in a bubble bath, because why not, I guess. This scene comes right after Michael Burry, who's played by Christian Bale, right after he's kind of discovered that the mortgage market is deteriorating and that he wants to short it. He's actually on the phone with his boss explaining that he wants to short the housing market as a whole. So let's take a look into the explanation she has.
Here's Margot Robbie in a bubble bath to explain.
Basically, Louis Ranieri's mortgage bonds were amazingly profitable for the big banks.
So you remember that Louis Ranieri is the guy from the very beginning of the film who is the father of mortgage-backed securities, based on the real Louis Ranieri, who worked at Salomon Brothers. Salomon Brothers was one of the investment banks, one of the pioneer investment banks in bond trading. And it's also one of the investment banks that sort of developed the kind of toxic investment banking environment that we know this day. The chest thumping, the giant cigars in the office, the whole shebang. Some of that came from Salomon Brothers. There's actually a great book called Liar's Poker. If you're interested in reading about Salomon Brothers, which again, kind of bred that environment, it offers a great insight into the inside of the company. Really good book.
They made billions and billions on their 2% fee they got for selling each of these bonds.
So just to quickly explain the structure of the mortgage bond or the mortgage-backed security, they kind of use the terms interchangeably. But essentially, you have your mortgage, which is a bank and a borrower who's trying to buy a house, right? So the bank lends them money and the borrower pays them interest on that loan until they pay it back. But the banks would actually sell these mortgages or, kind of the rights to the interest payments to investment banks. And those investment banks would put them in these mortgage bonds or mortgage-backed securities. And then they would sell units of that pool to investors. And that 2% fee she's talking about is how this investment bank actually made money. So the interest payments are going through the investment bank and to these investors, and the investment bank is collecting 2% of the value of the whole fund, of the whole pool of money. And yes, that's how they made a bunch of money because, obviously the bigger the pool, the more you make from a 2% fee. Or the more pools you have is probably a better way to explain that.
But then they started running out of mortgages to put in them. After all, there are only so many homes and so many people with good enough jobs to buy them, right? So the banks started filling these bonds with riskier and riskier mortgages. Thank you, Andrew. That way, they can keep that profit machine churning, right? By the way, these risky mortgages are called subprime. So whenever you hear subprime, think shit.
So subprime mortgages are, like she mentioned, higher risk mortgages. But they were higher risk for two reasons. Not only were they riskier because they were being given to people with lower incomes and reaching out to lower income communities to fill in the mortgage gap that these investment banks were trying to fill, but it was also riskier because the subprime loans would have certain features in them that would make them seem more attractive, but were sort of predatory in nature. So things like low interest rates for the first few years, but then they would balloon in later years. So for the inexperienced buyer, the inexperienced home buyer, they might see, wow, like for 3 years I get this low rate, but then in a few years that interest rate would balloon, it would increase. And a lot of people didn't understand that or weren't prepared to deal with that, which is why we saw this deterioration in the housing market. That and among other factors caused kind of that downturn.
Our friend Michael Burry found out that these mortgage bonds that were supposedly 65% AAA were actually just mostly full of shit.
this probably goes without saying, but just make sure people are all on the same page. AAA is obviously a safety rating. So the way the scale works is it goes from AAA to AA to single A, and then it goes to triple B, double B, single B, and then C, and I think it goes further past that. And the A's, anything that's in the A range, is considered investment grade. So it's a safer mortgage that's given to a credible borrower, and what it does is it just shows that this person is more than likely to pay off this bond, and it will pay a lower interest rate as a result. So when she's saying AAA, she's saying that these securities were given this high rating even though they were full of these subprime mortgages, which were probably in the B range. Anything in the B range was considered junk or high yield, which it's kind of, again, self-explanatory. They were higher interest bonds, but they were also riskier. They were junk. The people on the other end of the borrowing, they were less credible and they were more likely to default. But people didn't realize that because, again, these B-level bonds were hidden under a AAA safety rating of the mortgage-backed security.
So now he's going to short the bonds, which means to bet against.
Simple enough.
Got it? Okay. Now fuck off.
Yes, ma'am. Sorry to disturb you during your bubble bath. Not really sure why I'm here in the first place, but... So, obviously, the first one's easy enough to understand. Second one is Anthony Bourdain, unfortunately, the late Anthony Bourdain. This happens right after Jared Vinette, the character played by Ryan Gosling, after he's talking to the Front Point partners, the people with Steve Carell and the other characters there. He's actually based on a hedge fund manager named Greg Lippmann. So they changed some of the names of the people in this movie from reality, but they're all based on real people. So yeah, let's take a view at Anthony Bourdain's explanation.
Okay, I'm a chef on a Sunday afternoon, setting the menu at a big restaurant. I ordered my fish on Friday, which is the mortgage bond that Michael Burry shorted. But some of the fresh fish doesn't sell. I don't know why. Maybe it just came out halibut has the intelligence of a dolphin.
So I believe Anthony Bourdain's taking kind of the viewpoint of the investment bank. So what the investment banks are doing. So he's talking about the mortgage bonds, which are, his analogy. He's using fish as an analogy for the mortgage bonds. He's explaining that some of them are not selling, maybe because the halibut, it's found out that they have the intelligence of a dolphin. People don't want to eat halibut anymore. But a better explanation, I think, would be to say that the fish is sick or there's some illness with this fish because the mortgage bonds were less attractive, right? This is explaining how CDOs would take the bottom of the barrel mortgages that didn't sell individually and then group them together into a different product to make them more attractive to investors.
So what am I going to do? Throw all this unsold fish, which is the triple B level of the bond, in the garbage and take the loss? No way. Being the crafty and morally onerous chef that I am, whatever crappy levels of the bond I don't sell, I throw into a seafood stew. See, it's not old fish. It's a whole new thing. And the best part is they're eating 3-day-old halibut. That is a CDO.
So, great explanation of the CDO. Not all CDOs were intended to be like this, obviously, but that's kind of what happened. So the CDO is kind of an extra layer on the mortgage investments. So you have your mortgages, you have your mortgage-backed securities, which are full of these mortgages, and then you have the collateralized debt obligation, which is full of these mortgage-backed securities. And the difference was that the collateralized debt obligations would do this thing called tranching. They would separate the income streams from these mortgages, from these mortgage-backed securities, into different tranches. These tranches would be labeled as different risk levels. And effectively, what that would do is people who wanted to invest in this CDO but wanted less risk could buy a higher tranche, and they would get paid first. So they would get paid the money that comes in first to make sure that they get their return. They get lower return because they're taking less risk, but they get paid first. People in lower tranches would be paid after the fact. And if there's any defaults or any payments that don't come in from a late payment or whatever, the lower tranches would suffer. So they would be the ones who take that loss. But they're also paid higher as compensation for taking on this higher risk. And finally, we have the last cameo, which is actually two people, Selena Gomez and Richard Thaler. Richard Thaler, as they point out in the movie, is the father of behavioral finance, which is a branch of finance that relaxed the assumption that humans were rational, which is an assumption made in a lot of traditional finance and economics. And it actually looks at the errors and the biases that we exhibit when we deal with money. Now, this scene comes right after Steve Carell's character, who's Mark Baum, right after he discovers that there's roughly 20 times more money insuring mortgages than there are actually mortgages. And we'll explain that more in a second. Interesting fact, though, Mark Baum is not the real name of the person that character is based off. His real name is Steve Eisman. I don't know why they changed the name. Maybe because they didn't want Steve Carell and Steve Eisman to have any confusion there, I guess. But yeah, Steve Eisman is who that's actually based off of. So yeah, let's take a look at the final cameo, which I might actually add some value here because it's probably one of the more confusing of the three.
Well, here's Dr. Richard Thaler, father of behavioral economics, and Selena Gomez to explain.
Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack hand.
10 million because this hand is meant to represent a single mortgage bond.
So again, mortgage bond, mortgage-backed security, an investment
Selena
with more
has
than
a
one
pretty
mortgage
good hand
in it.
Here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So, my odds are good. I'm on a winning streak.
So the hand in this scenario is supposed to represent the mortgage-backed security. Winning the hand, or Selena Gomez winning this round, is supposed to represent the mortgage-backed security making money, or everything going as normal, as expected. So the mortgage-backed security, all the mortgages, people pay their mortgages, that money flows through to the investors, and they make their money. There's no losses on that. So that's what that scenario is. If she loses the hand, it kind of represents the mortgages in the mortgage-backed security failing, or the people defaulting on their payments. So that's kind of just to quickly explain what the hand represents here.
Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. A player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future.
So yeah, pretty self-explanatory, but the housing market had never before seen a correction of that size from the 2008 financial crisis. So people just assumed that mortgages were solid investments. They were getting good credit ratings, and because something had never happened before in that market, they just assumed that it was free money, more or less. In this case, all these people on the side are seeing Selena Gomez is continually winning her hands. Therefore, they're going to try and make some money from it.
During the real estate boom, markets were going up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now this is the first synthetic CDO.
I love Selena Gomez. I bet you 50 million she wins, and I'll give you a 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet.
All right,
Now,
we're going to dive into this. This is where we get kind of complicated. Before we talk about the synthetic CDO, remember what the CDO is. You have your mortgages, which are these, rights to interest payments from borrowers. You have mortgage-backed securities, which are pools of these mortgages that investors buy. You have CDOs, or collateralized debt obligations, which are pools of the mortgage-backed securities that are tranched so that you can take different risk levels. And then there's the synthetic CDO, which is going to be an investment that mimics a CDO without holding any underlying mortgages. So there's no actual mortgages involved with this investment. So how does that work? Well, the movie does a great job of explaining that it's like a bet. It's like people on the sidelines taking bets on someone else's mortgages. So how does that look? Well, they use something called a credit default swap, which you can think of as sort of like an insurance contract. It's insurance on a mortgage being paid. So if a mortgage defaults, the person who owns that insurance contract will get a payout. So what people were doing they were selling these credit default swaps on other people's mortgages to people who had nothing to do with those mortgages. To these speculators who are trying to make money on people's defaulting. So that's the credit default swap. And the synthetic CDO would be full of these credit default swaps because they almost mimicked a mortgage. You had the guy in this case paying premiums to this lady as if he was a borrower borrowing money to buy a house and paying interest payments. So that's how the money was was collected to pay for these synthetic CDOs. That's how the money was made by investors who bought these synthetic CDOs, is that there were these credit default swaps being sold to speculators. These speculators were paying premiums. That money was flowing through to investors of the synthetic CDO.
Somebody else is going to want to make a bet on the outcome of their bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win. So I want a great payoff.
How about 21?
Deal.
So I think here they're trying to explain the CDO squared, which is more or less just a CDO of CDOs. So we're going one layer deeper. In this example, what's happening is that these two new people are buying a product that's made of these synthetic CDOs, so that if the mortgage, which again is Selena Gomez, if she loses her hand, the original CDO will lose money. It will stop making interest payments. And then that means that the person who owns these people, the person who buys that CDO, will stop making money and will lose a bunch of money because they have a payout to the speculators.
And this will go on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
You okay?
No. I actually feel pretty sick. So I'm going to leave.
So that's essentially what happened, right? You had all these people betting on the mortgage market that it was solid as a rock because there had never before been these widespread defaults in the mortgage market. And then the unexpected happens. A black swan event happens and all these people lose money. So yeah, that's the 3 cameos explained. I don't know if I added any value or not, but if I did, let me know. And maybe I'll do another one sometime. But you know what? I want to do this for fun. I thought it was a funny idea. So hey, why not? Thanks for watching. And yeah, see you in the next one, guys. Cheers.